Welcome everyone who's joining just now to our Capital Allowances, Opportunities and Pitfalls webinar. We'll be getting going shortly. We're just letting everyone into the event. It'll just take a minute or so, so bear with us with the radio silence while we just let everyone in. Hi everyone who's joining just now. We're just letting everyone into the event, so just give us a minute or two and we'll get going. Okay, just last few people, I think, coming into the room just now. Oh, a couple more. Okay, that's probably us for the moment. Are we good to get going, guys? Yeah. Okay, fantastic. Well, welcome everybody to our webinar today. This is Capital Allowances, Opportunities and Pitfalls webinar. Today, our MD here at Whisper Claims, Mike Dean, is going to be chatting to Alan Cadden and Lois Sterling, both directors of Chevetta Consulting, who help business owners and investors to use their commercial property to reduce their tax bill through capital allowances. If you don't already know us here at Whisper Claims, we are the only fully automated software platform designed specifically for accountants to deliver R&D tax claims quickly and easily in-house without the need to outsource. More than 130 firms across the UK are already using our technology, and our mission is to enable accountants to provide the best possible R&D tax services to their clients, supplemented by our comprehensive range of support and advice. Anyone who's attended our webinars previously will know that they're usually designed to assist and help our community to become more confident in discussing and ultimately fulfilling the R&D needs of their clients. However, we have taken a slightly different direction for you today. So capital allowances are one of the oldest forms of tax relief available to taxpayers with commercial property. Today is a discussion around the capital allowances scheme, whilst reflecting on the similarities between it and the R&D tax scheme as well. We'll have a usual Q&A session at the end, but we'll also be very, very happy to take questions as we go through the discussion. So please do feel free to jump in and ask questions. That leads us nicely on to some housekeeping for today. So if you want to chat to us, please have your chat box open with the settings switched to 2 panelists. And if you'd like to chat to us and the audience as well, switch your settings to panelists and attendees. If you do have any questions, please do use the Q&A box. And if you want to ask a question anonymously, please be sure to toggle your settings to anonymously. You can also upvote and comment on the questions in the Q&A area as well. So if there's something you're particularly interested in hearing answered within the session, this will push that question up by popular vote. Okay, hopefully that's all clear. So without further ado, I'd like to hand you over to Alan. Alan.
Thank you very much, Susie. My name's Alan Cadden and I'm a director of Chevetta Consulting. I've actually been in tax now for 25 years, believe it or not, and 16 of them have worked in specialising in capital allowances for commercial property. And 6 years ago, we formed Chevetta Consulting as well with my business partner, Lois. So thanks so much.
Hi, I'm Lois Sterling. I'm a director of Chevetta Consulting and I'm based in our Edinburgh office. I'm a trained QS and a tax technician, and I've been in the construction industry for over 30 years, and 20 of those are within the tax field. And I've worked with owner-occupiers, through to property companies, through to the financial institutions, and helping them resolve their capital allowances issues. Mike, do you want to take
Thanks,
over?
Lewis. Just for anyone who's looking for contact details for Alan and Lewis, by the way, I've just put their a link to the website and also a link to Alan's e-card as well in the chat. So if you want that, there. Sue did a great intro to Whisper Claims earlier on, so I won't bore you with going over that. I'm Mike, the MD of the business. As Sue said, we've been around for a couple of years or so. Obviously, we're steeped in R&D. And one of the things that struck us was the similarities between the challenges faced by accountants with R&D tax claims and with capital allowance claims are very similar in a lot of respects. So to just kind of set the scene for this, Alan, could you give us a little bit of a flavour of why it is that accountants and others don't maximise the value of a capital allowance claim?
I think before I elaborate, I think the short answer is a lack of awareness of what's involved. I mean, accountancy principles make accountants aware of capital allowances, and claiming the capital allowances in things like vehicles, computers, furniture, equipment, it's relatively straightforward. Much of the detail is in an invoice, so the accountant can pick it up and put it in the relevant pool as required. However, when it comes to a property, a commercial property, things get a bit more complex. The tax relief isn't on the invoice. It needs to be valued rather than, so a different set of skills is needed. So when it comes to expenditure on purchases or constructions or fit outs or refurbishing or even extension of buildings, really a different set of skills is required in order to value the fixtures and fittings, to value the tax deduction. And this comprises things like law, surveying, an actual knowledge of property in the buildings, and indeed tax. And indeed, accountants often consult capital allowances surveyors when they need to value tax deductible items in commercial property. It's either purchased by their clients or, in particular, receive single line quotes from builders or contractors. Within that quote, there's going to be items that qualify for tax relief, some that don't, and some at different rate. And in addition, finally, the legislation has also become increasingly more complex with additional restrictions on what can be claimed, new forms of capital allowances, and indeed the removal and amendment of other allowances. So that's, I think, why in the scope they're not maximising the claims, in my opinion.
Okay, as I said, you know, that's really similar to R&D, and that kind of notion of the legislation being complex is kind of off-putting for people to get involved, which is then a shame, of course, because the end client is missing out on a potentially considerable tax benefit. So in terms of today's conversation, what's the kind of structure of the chat? What are you going to work us through?
Well, today I would like to look at claiming capital allowances for fixtures and fittings in commercial property. We're looking at properties where someone carries on a business, not properties where someone lives. So something like a buy-to-let or an HMO wouldn't come within this. In particular, Mike, I'd like to discuss why these tax deductions are so valuable to accountants' clients, a bit of awareness of the types of buildings that are eligible. I'd like to also talk a little bit about the process involved. Maximising claims includes certain processes for establishing entitlement to claim and the actual valuation of the fixtures and fittings. I'd like to also elaborate that although we specialise, we are aware of the problems that accountants face. I'd like to just develop these a little bit. We know they face problems in terms of time and explaining this to clients as well. And although it's a very small piece of legislation, the vast amount of statute and legislation and compliance that accountants deal with, it can be very, very valuable. Thanks.
So in terms of, I suppose a good starting point then is just giving us an overview of what the benefits actually are.
Yeah, thanks. Can we change the slide, please, Susie? So when we talk to property investors, particularly about tax, you know, they tend to think, all right, okay, here we go again. They struggle to visualise it. So we like to get them to visualise the benefit and see how valuable it is that capital allowances can give them. And at the moment, you can get 100% deduction for the first £1 million of qualifying plant machinery, including fixtures that incurs in a tax year. And in a building, this can be things like hot and cold water systems, heating, lighting, kitchen, bathrooms, fire and security alarms. And to put it in the bottom context of bottom line, the bottom line for a company that can claim the full amount of this expenditure is a cash flow advantage of £190,000, equivalent to getting 5 employees a BMW Z4, or for a higher rate taxpayer, a 40% tax rate. It's much more valuable. The bottom line cash benefit is £400,000. And recently in the budget, we've also had for companies, we're now in the age of the super deduction. So for companies investing in unused new plant machinery, and this includes again fixture and fittings and buildings, we have the super deduction, which means that for main pool items, there's a deduction of 130% for the next few years. So that'd be in things like fire and security alarms, or for special rate pool expenditure, integral features, it will now be 50%. So things such as lift will now get that accelerated deduction.
Just a little sort of side question there. Are there any, in what you've just described there, are there any obvious areas, obvious to you, that people often miss? You know, what are the things? Because I guess it's kind of obvious in headline terms that the buildings themselves are eligible. But underneath that, what do people tend to miss out?
I think they miss a lot of deductions. I mean, MD can see a light bulb fitting from B&Q is, 50, 60 quid, for example, just take a figure from the top of my head. But what they don't often see is what's involved in putting that: the hole in the wall, the electrician, the wire going to the distribution board. So all these items cost money, they have a value. So whilst you might see a light fitting in an invoice, what is involved to get that light burning and switched on is maybe not seen. So sometimes it can be getting undervalued as well. And I really feel it's a lack of awareness is why it's not, the water is not getting drawn from the well, Mike.
Yeah, and so it's a combination actually in what you've said there of both the hardware, if you like, the obvious items, and the services that wrap around that result in the item getting fitted, installed, etc.
So moving on to the next thing, I mean, in our view, accountants should really be encouraging their clients to claim capital allowances for their business properties. And to claim the accelerated release I've just discussed in the last time, it's better if capital allowances are looked at certainly within 2 years of incurring expenditure, a bit like similar to R&D as well, where you have to look at 2 years. However, you could have a situation where somebody did a refurbishment works, 10 years ago. We had a situation where somebody started lockdown and done a hotel extension in 2011 and never claimed the benefit of allowances. So, but there's still opportunities to claim. Therefore, if a accountant takes on a new client, it's a really good opportunity to raise this with them. What has been done? What have you done before? Have you had a surveyor visit the property? Do you have a copy of the report? Another example, we had a dentist who purchased a building in 2008 recently from a developer and not claimed. So there are opportunities. And claiming, because they might elaborate, Mike, claiming capital allowances can give business owners real benefits. It reduces their tax bills. This frees up cash, so you might want to pay dividends, reward yourself, give money to employees, marketing, gives an opportunity to develop their business. It also reduces overall costs of capital projects, which can reduce the lending risk, because the less money you give to Mr. Taxman, the more money you have to give to the lender. And for investors, it increases the return on investment just by claiming the value of your heating, your lighting systems in your building. But I think as well, sometimes people don't realise that this has been a real piece of legislation since 1878, and HMRC will actively encourage to claim it. Like R&D, they've got revenue manuals online to tell everybody about it. But the alternative really is to give HMRC more money for doing this. But with that, I'd like to hand over to Lois to talk a bit more about what types of properties qualify.
Thanks, Alan. Claims can be made whether on any of your sort of capital expenditure on property, whether that's been a purchase, a new build, refurbishment, fit out, or even extensions to properties. The one where we find most problems with are the purchases, where claims don't tend to be maximised. Sometimes when we speak to people about purchases, they've taken at face value what has been put into maybe the purchase contract in a joint election, and haven't looked fully at all the history. Maybe, you know, if the vendor has bought the property before 2008, there are overage claims available on what is deemed to be new plant and machinery, cold water, so power, the lighting, which in an office building can be quite substantial. And we find these are quite often missed because it's not, the history hasn't been looked into the property. Capital allowances applies to all commercial property sectors, be that retail, residential, care, healthcare. The only real exception is when it's deemed to be a dwelling. Now that's looking at buy-to-lets, HMOs, student accommodation. But there are exceptions to that. If you take student accommodation, where there are core areas, you know, stairs, lift areas, they tend to have health and safety features in them, emergency lighting, they could be carpeted, they'll have ordinary lighting, could have heating in it. That's all claimable too. And sometimes those areas get missed and the claim's not maximised.
Just a couple of questions there, Lois. Just a couple of things you've mentioned that kind of spring out to me. You both mentioned 2008 as an important date. So what's the important thing about that? Is that was there a change in legislation then?
Yeah, there's a change in legislation. It's what's typically referred to as integral features. So the legislation changed around that, and we got new plant. So where a building was owned before 2008, you couldn't claim on these bits of plant and machinery. It had to be a new expenditure. Anybody buying the property after 2008, that's deemed to be new expenditure on these items, the cold water, the general power, lighting, etc. They can now claim on those, and sometimes that is missed because the history is that
it changed for the better in 2008. Became more open.
Yeah.
Okay, and you also mentioned that. I think I understood this. And essentially, you can go back as far as you need to go back. There's no real limit on, in the way that there is with an R&D claim. You've only essentially got 2 full tax years to go back. In this case, you can go back as far as you need to.
Yeah, we can go back. You know, the benefit gets less and less the further you go back. If you'd originally claimed when you bought the property, you could have got 25% deduction, but now we're down to 18 and 6% deductions on things. So you haven't lost it, just the amount of tax relief you could be getting would be less now.
Okay.
But there's no time limit.
Okay, and the value of the claim is associated with what? Is it associated with the building, or is it associated with the business? By that, I'm thinking about perhaps the example where you bought a company that's got assets that haven't had a claim on them. Is there any opportunity there?
Yeah, there is too, and it's associated with what you've actually incurred. So with a purchase, it's what if you buy the property, it's an apportionment between the building, the plant and machinery, and the land value. So you can, depends on what you've paid for the property, what the building is actually costs to rebuild. So you can get a multiplier effect, and that can either boost the allowances or reduce the allowances. If you bought a company, there are allowances in there. Tends to be what the company has spent. You do a lesser of calculation, what it's worth now and what it was worth when it was bought. So there's just like calculation there to look at, the lesser of calculation. But buying a property, if there hasn't been a claim done in any property expenditure, there is a claim to be looked at. Yeah. Okay,
excellent.
Yeah. Do we go on to the next slide then? Hi, Suze, can I get the next? Yeah, thank you. This is a sort of the process that we go through when we're looking at maximising a claim. And purchases tend to be the difficult one, where things are missed mostly by anybody else looking at this. As you talked about earlier, Mike, R&D, it's very similar to capital allowances. It all comes down to the amount of information you can get and how much you understand about the business or the actual property itself and what that property is being used at. So when we look at purchases, we look at the full history of that property, we go through all the transactions that it had to see who's claimed, who hasn't claimed, because if this is the first time a property's come into the capital allowances world, if you've bought it from a pension company, the claim could be unrestricted. And if that's not followed through, a huge claim could be missed out there. So it's quite important to understand that. And we talked about the overage claim, making sure that you don't take the election as face value, because sometimes when we go out and do a survey, we find that sometimes things are missed in a claim because it's just maybe been a desktop exercise that somebody's carried out for the vendor at that time. And again, knowing the sector helps maximising. Know the land value in that area, because you have to do that. I talked about a minute ago about this apportionment of your purchase price. You've got to break it down into what the rebuild cost of that building is, what the land value is, and what the plant and machinery is. So you need to do a detailed survey to understand what plant and machinery is actually in that building, and maybe what belongs to the tenant and what doesn't belong to the tenant. So that's really the purchases is one of the more difficult areas where claims aren't maximised. Construction, again, it's gathering all the information that you can have, ensuring that you've got the full documentation, the drawings, the specification, the costs that have come from the contractor, and again, a detailed survey, especially if that's been a refurbishment or a fit out. Alan mentioned earlier all the add-ons that you can have in, the builder's working connection, why was that, why was that floor maybe strengthened? Was it to put in a bit of plant and machinery? Was it to put in a water tank? Did the floor need strengthened? Well, that can all be claimable in your tax return. And it's looking at establishing what fees were paid, architects, project managers, quantity surveyors, getting all those, because all those costs can be added in to the claim, as well as VAT if the client can't reclaim their VAT.
You mentioned in your personal introduction, Lois, of your background, and you mentioned that you're a surveyor.
Yeah.
And listening to what you've just described there, it seems critical to have those kind of skills involved in putting a claim together. It's not I guess the message there is it's not a pure financial exercise. Just looking at, as Alan said earlier on, just looking at invoices and transactions isn't enough. You've got to get underneath the detail of the valuation, which is a surveyor's skill set.
No, as Alan mentioned, invoices tend to come in and they're one-liners, lump sum payment, valuation 1, 2, 3, and they're just a lump sum payment. So it's understanding what actually is contained within that and how you can maximise it. Is where's the fees that go on that? Is there a design element in that can all be added on to that? And finally, it's just making sure that the schedule complies with the HMRC's requirements, which is really important now, where we've got to keep records, because we've had these new super deductions, all needing certificates to go forward to see what's been claimed, the annual investment allowances, structures and buildings allowance. It's all about records and keeping them to ensure that your claim is maximised, what you've claimed on, and that when you come to sell the property on, you can either do that at tax written down value if you can't get a £1 election, so you maintain that tax relief within your company and you're not letting it go and having a tax clawback. It's all too important about maximising a claim.
Yeah.
I think that's really all I've sort of talking about maximising claims. If you want Alan to hand over into the next slide.
Sorry to interrupt, guys. I've got a couple of questions if you wouldn't mind answering them just now. So I've got one from Tom who said, if you've purchased a property and the previous owner had made a claim, would that change any subsequent claims?
No, you'd have the election and the amount would be in that. So we would recommend that you check that election, make sure that it's well defined what they have in that, so that going forward you've got that, but also then look at when the property was purchased, could you do an overage claim? It's not going to affect what you can claim as such. That's the amount that you can claim. You would then use that in your pool and write the allowances down. And then when you come to sell that property on, you have the record that you need then to provide to the next purchaser in line. Does that answer the question?
Hopefully, I'm sure Tom will come back if it hasn't. I've got a couple more actually. So Louise has asked, who can make the claim? Like with R&D, it must be a limited company. What are the rules around this type of claim? Is it down to the owner of the business and the building, etc.?
It depends on the holding structure. If you hold it personally, you can make the tax allowance, the claim. If it's a company, limited partnerships, financial institutions have, REITs, there's all different things, and it's all that business. Whoever owns the property makes the claim, really. There are tweaks and things about what you can have if it's a partnership with a commercial thing, and you can't have an annual investment allowance, but it basically, whoever owns the property makes the claim and puts that into the tax return. If it's a partnership,
it's not as limited as an R&D claim in that sense then.
No, there are certain things, like the super deduction. It has to be a company gets a super deduction. You can't claim that 130% deduction if you're an individual. So that there are quirks around who can have it, but mainly if you own a property, there's some sort of capital allowances deduction that you can have if you're not restricted by the legislation or your purchase contract.
Okay, I've just got one more just for the moment from an anonymous questioner. Do you have to have purchased the property? Can you still claim if, as a business, you have incurred refit or refurb costs?
No, it's under what we call a relevant interest. If you've got a relevant interest in the property, so a lease, and you've incurred expenditure, then you have an entitlement to claim. Not a problem.
That's all for the moment. Thanks so much for that. Would you like me to move to the next slide?
Yeah, I think Alan, yeah.
Thank you very much. So we understand from experience that accountants face a number of problems, which makes the claim process a bit more difficult to them. And we'd summarise these as the first problem they face is how to physically do the claim, the processes that are required, for example, like valuing land, putting replacement cost estimates, measuring the property. We know there's a problem as well, the time taken to carry on the due diligence, going back to 96. And also probably the biggest problem they have in the physically doing the claims is overcoming information deficits. What do you do when the information, the detail is not there? And that's where we help a lot of our clients. Another barrier we know they're facing is the process of valuing the fixtures themselves. I've got an accounts degree myself, so I know that this is not included within accountancy training. And picking up things from an invoice is an exact science. You know what the amount is, but valuation is really an art. It's not an exact science. It calls judgment. It requires experience as well. So we know established valuation techniques and would refer to things like the RICS Red Book and doing it, which is not in the normal library of an accountancy firm. I also appreciate as well, it's sometimes difficult to explain to clients. I know that accountants are the client's most trusted advisor, but sometimes to claim allowances for property, they maybe need to be aware that land valuation will be involved in replacement costs, and sometimes clients are not always aware. And probably another big hurdle the accountants face that comes is access to these services as well. We know it's really only big four accountants and big property consultants that really do this, but there is access, there is help out there to maximise your clients' claims. Thanks. Next slide, Sue. Yep. So today's been a bit of a small test on claiming allowances in commercial properties that can benefit your clients. And I realise that you might have a lot of questions. So if you do, or you want to spend a bit more time with you to explain a bit more about the process and what's involved, please feel free to get in touch with myself or Lois.
Alan, couple of questions. We'll wait and see if there are more questions from the audience, but a couple of things struck me there on that last slide. One is the scope for HMRC inquiries on these claims. So in the R&D world, we it's the kind of bane of people's lives is the scrutiny, if you like, that a claim goes under. Is that the same for these claims? Is there are there any kind of particular pitfalls around the HMRC end of this process?
Generally speaking, the inquiry time for capital allowance is the same for any sort of corporate or individual self-assessment. They would have the 2 years inquiry window from the accounting period or the tax year you submit it in. If they don't raise anything there, they don't tend to raise queries. But in my experience, if you give the revenue enough detail and a good robust claim explaining your processes, what you've looked at, giving them plenty of photographs, letting them see the property, let us see what's involved, being as open with them as possible about how you've done things, your land values, they don't tend to query things. They might want to clarify something within a topic, for example, furniture and fittings, what's in there, just to clarify. But if you do a good, robust claim, then that should be really the level of excitement that's involved.
So it's similar to R&D. The quality of the report that you submit has a big impact on that down the line.
Very much so.
Yeah, land values used to be one of the things they used to love to pick on when we're looking at a purchase claim. They would always like to argue that, but as we've moved away and they've restricted what you can claim on a purchase, that's coming up less and less, and it's more about the individual, as Alan says, what's actually in that title of fixtures and fittings or heating or whatever. They want to know what you've actually included.
Brilliant. I know we've got a few questions coming in. Just one more from me before we get into those. In the R&D world, there's a kind of generally accepted way of pricing for this kind of work that we have to say that we've been disrupting with our software. But generally, R&D claims are charged on a contingent fee basis. Is that the same? What sort of fee structures do you see in the capital allowances world?
Well, firstly, our fee structure is bespoke. We have to look at, firstly, is a claim viable for the client? If the cost outweighs the benefit, there's no point in doing it. The second thing is we've got to see the benefit, what their tax rate is. Are they a limited company? Are they a taxpayer? Generally speaking, they can either be performance related or fixed. It really depends on how the client feels about it. Some of them might not be familiar with the process and just want to have something fixed. Some would maybe want to see what can you do, how good are you, and want to go with performance.
Okay, so it's open-ended, really, depending on the particular scenario. Okay, cool. Sorry, Suze.
That's all right. So we've got a few questions coming in just now, so we'll turn our attention to those in just a moment. Just before we do that, I've just got a couple of reminders for everyone. Our Whisper Claims Fundamentals of the R&D Tax Scheme training courses, which are proving to be very popular, are scheduled and available on our Eventbrite page. The link will be in the chat box in a moment if anybody is interested, but be sure to book swiftly if you're looking for something quite soon, because places are limited and they're selling out very quickly. Our May course only has one space left just now. And just one other thing, if anybody on the webinar today is interested in seeing a demo of our Whisper Claim software, my email address will be in the chat box below. Please do get in touch. I'd be very happy to walk you through the system. Okay, so we do have a couple of questions. Thank you so much for everyone who's joining in the discussion. Firstly, from Louise, if the building has a change of use on it from a domestic garage workshop to a commercial holiday let type building, and the building has never claimed capital allowances, would this be allowed? And she does just have a little follow-up saying she has a lot of architects that she deals with that are becoming more involved with holiday lets, hence the question. Who wants to take that one?
Yeah, do you want to say that one, Lois?
No, there shouldn't be a problem. We look at what, when the timing of the trade has started as a holiday let, we look at what the value in the business. So if I claim on what you have done to put it into furnished holiday lets, you've got that, but there could also be plant and machinery still in it when it was its other business, so there's a claim there as well, and that looks at the value that you've transferred over. So there's no problem in claiming on that. It just looks at what expenditure you've incurred, when you've incurred it, when the trade has started. So that, yeah, there's not a problem in doing a claim.
Fantastic. Okay, thanks. Next one from Paul. Are there any minimum claim sizes?
For us, no. we look at the value that the client is going to get. And if the first year benefit, if our fee is going to exceed the first year tax benefit, we would then come back and tell you, no, that's not, the cost is not viable. But we tend to like to have a look at everything, because sometimes what we're told isn't quite the story and we can make it work. And it's very rarely that we can't make something that works. We try to say that there's no real limit into what we can look at. We like to look at everything and give the full picture and understand why. So, yeah.
Great, thank you. Okay, so I've got a question from Andy and a slight follow-up. So how is the claim made? Is the claim made in the next tax return, or is it by way of an amended return?
I'll say that one. So it really depends what works. The valuation, we would submit it and give the independent report to the accountant, and the accountant would then look at the position. Is it viable for them to put it into this year, or can they get a refund in a prior year? Depends what's still open and within that 2-year window. So it really depends on what the individual taxpayer's circumstance, and that would be that would really be a decision for the accountant to make themselves, to see what's the best benefit for the client. That would be it, really.
Okay.
Yeah, I think with the super deduction and things coming in now, and the current market, there'll be a lot of losses going about, and sometimes you can carry the losses back depending on how the claim is made. So you may be able to, because you created a loss, take it back further in your business and get tax relief, rather than just looking at it as purely a capital allowances claim these days. There are other things that you can do with it.
Okay. I have a question here asking, what information do you have to submit with the claim? That might be quite a big one.
Ordinarily, the claim document tends to, if it's detailed enough, look after itself in terms of reproducing the information. You don't have to submit oodles and oodles of paper. A good level of photographs we would certainly recommend to give the revenue a flavour of it. With land remediation claims, as in the 150% deductions for companies who are dealing with, say, asbestos, we'd maybe tend to include the asbestos survey report, maybe some validation reports. But ordinarily, the claim document should stand on its own merit.
Okay. Another one from Tom. Does having the property in a SPV, but the fixtures and fittings being done in a separate entity, change how the claim is treated? And then he's got a follow-up. Would it be separate claims?
Yeah, you have a separate claim there because you've got different ownership, and you're looking at, that's getting quite complex, and you're looking at long funding lease relationships too, as to whether who owns it and what have you. So there's definitely two claims that would need to be done. Who can claim on what? You need to look at the structure, but there should be able, the SPV would have a claim maybe on the building and the actual fixtures that are on there, the heating. If it's loose fixtures and fittings that the operating company may have, you'll have a separate claim on that. So that's sort of, you're getting into quite a complex sort of capital allowances situation there. So we would recommend full details. You have you can't really answer that without knowing how the lease is and how the whole structure is and the business is set up. But yeah.
Thank you. Another question from Andy. If you're renting the property, can you claim tenants' improvements?
Yeah, if you have a lease of a commercial property and you're incurring expenditure, like for example, you might have a shop and you're fitting out, you're putting counters, lighting, mirrors, kitchens, all that sort of thing. Yes, you can claim. What they call it is the relevant interest, which either you own or lease the property or have a license to.
Thank you. Okay, a couple more, probably more specifically for yourselves and us, I guess. So firstly, do you pay an introductory fee to accountants who pass potential claims in your direction for the work time involved on our part in getting to that point with the client?
Yes, we have introductory agreements, which if anybody wants to talk to us, they can speak to myself or Lois out with the call.
Great. And just one more for the minute. Somebody's asking if we can do an FAQ sheet covering these and other questions. Just to let everyone know, I will be saying this again in a minute, that we will be sending out a recording of the full webinar to anyone who's been registered via the Eventbrite page. So you'll be able to listen back and hear the answers to the questions too.
Yeah, that, people will have our contact details. We're happy to take, quick calls about any queries. We don't time charge to the minute for things. We're happy to have chats with people and help their understanding.
I did pop a link to your website in the chat earlier on, Lois, and that, your website's got some fairly comprehensive information in there as well. So I guess encourage people to have a look at that too.
Yeah, thanks, Mike. Yeah.
Fantastic. Well, unless anyone has any last minute questions, that's us gone through the whole. Oh, I've got another one coming in. Sorry about that. Louise again. Hi, Louise. If you've claimed capital allowances and then you sold the property, would you need to make a repayment?
No, you wouldn't make a repayment. But what I would advise is that before you sell it, you make sure you have what they call a 198 election, which means it's a bit of paper that says what you've claimed on and the value you're selling it for. If you want to keep the tax, you've got options here. If you want to keep the tax relief, you would have that election at £1, meaning that you're selling all the fixtures and fittings you claimed allowances for to the buyer for £1. Alternatively, you might agree a separate value with the buyer. Similarly, if you're, I'm not going into too much detail, but if you're buying a building as well, that from a second-hand building from someone who could claim allowances, you are going to need that election as well, to either for them to retain allowances, for you to claim allowances as well.
Great, that's fantastic. Well, seeing as we're coming to the end and there aren't any more questions just now. Oh no, sorry, and again one more. Okay, this is for us, I think. Do Whisper have any plans to develop software to support capital allowances? Or is that a step too far?
You know what? I had a feeling. Thank you for that question, Paul. I had a feeling before we started that somebody might ask that, which is so that's interesting. That's come up. No, we as we stand, we've got no plans to do that. Although whilst we're talking about our product there, just for a second, we are building a much more flexible architecture in the background for our product that will lead us down the path of developing other applications on the back of what we've done. So it's kind of a watch this space. But no, to answer your question straight, Paul, no immediate plans to launch a capital allowances product.
Okay, well, as we are coming up to past, and that's us drawing to a close. If any other questions come in, we will get them answered. We'll answer directly. But just to say thank you so much to Alan and Lois for your time today. That was really fascinating, hearing the similarities between the two schemes and also the differences as well. Thank you everyone who's joined the webinar today for your time. As I said already, we will be posting a copy of the link on our blog, and anyone who was registered on Eventbrite will get a separate email with a link to the full recording, which you'll be able to see the slides on as well if you want to watch it back. If this is the first session that you've attended with Whisper Claims, all of our previous webinars are also on our blog, unless it was a closed session, which would be a subscriber only one. If any questions do spring to mind for us here at Whisper Claims or for Alan and Lois, you've got our contact details as well, as Mike said, so please do feel free to get in touch. We're always really keen to hear feedback, so if anybody's got any feedback on today's webinar, please do let us know. And if also you've got any ideas, or you'd like to input into some of the subjects or topics that that we're going to be discussing, or things that you'd like to hear about, please do let us know. Have a fabulous Tuesday, everybody, and we'll see you all soon. Thanks, guys.
Thanks, Suze.